Welcome. My name is Simon Dixon. I wrote a book called Bank to the Future a while ago, and I guess I'm going to start with the landscape of the different methods for you to raise finance, and how I think that's been slightly disrupted over the last few years, and how I think that's going to play. I'm going to try and do that in 10 minutes. So firstly, I've had experience in most of the funding methods personally involved. So I used to work in investment banking in my corporate career. And that was where I would help venture capitalists exit their company onto the alternative investment market in the UK. When I quit my corporate career, I started a business that I got angel funding for. And that was by a gentleman called Peter Hargreaves. His net worth is 1.3 billion. And he angel funded my last business. The business that we just started, which Bank to the Future, we're 2 years old but 3 years young since launch. We crowdfunded it as well, so we used a slightly different method. So all the different financing methods I've got personal experience on that I'll be going through today. I don't think so. Should I use the space bar? Okay. So I created my slides on a Mac, and they're probably butchered in the transition to the PC. But BC is what I call before crowdfunding. And before crowdfunding, you needed quite a lot of money in order to start a business. The friends and family round used to be a lot more. The friends and family round is called Triple F because you get all your friends, all your family, and any fools that will invest to back you at a very early stage. And the statistical likelihood of an early stage idea actually going into an exitable business is extremely unlikely, why they call it the friends, family, and fools round. But it used to be a lot more money that you need. Today, the world's changed so much that the friends, family, and fool round really is about £1,000. And that £1,000 is just an internet connection, a smartphone, and a laptop, which is probably where many of you actually started. And I'm assuming that everybody in the room already has one of those. So the startup cost to getting into business is significantly reduced. And the reason that you need that is because now, if you've got that £1,000 in order to get started, you can raise the finance through other methodologies I'd like to tell you today. So before crowdfunding, really you used to put your own money in, persuade some people to put the money up, and then if you traded for a year or so, the bank would give you an overdraft. The bank isn't so interested in giving you an overdraft anymore, so that form of finance has needed some disruption in recent years. And then if you turn that into a product and you build a prototype and you make some sales, then you might be able to persuade a high net worth investor to invest in you, which is what we call the angel round. So the angel round is always a precursor to getting some kind of institutional investment or some money from an institution. And then if you needed to raise larger sums after that, most venture capitalists, they look for a business that's already got angel funding already. They don't tend to get involved at the very, very early stage. And you can look for about 1 million to 25 million in that range. We think that the challenge we have with the venture capital market in the UK, and I know Octopus are here today, they might tell you otherwise, but we don't really have a venture capital market in the UK. They don't invest in ventures. They invest in fantastic management team with 15 years corporate experience, with perfect sales orders in a huge growth sector, and then only 1% of them might get some funding. In America, they've got a slightly bigger appetite for risk. In the UK, we're very risk adverse, so we don't really have a venture capital market. So my suggestion is that it may not be right for you at this stage. However, if you've got some angel funding before that, then you want to start building your relationship with VCs very early on, because they like to connect the dots. They like to see the progress that you've made and that you're growing very nicely in your funding stages. Once you've got VC funding, a wave of cash opens up to you. If you've got a good finance director, there's multiple sources of finance. You've got private equity firms that look for more mature businesses. And then you've got the capital markets, which is where I used to play. And the debt capital market. So once you've reached this stage, funding isn't really too much of a problem. However, this stage, there's a big funding gap. There's a big problem. So that's the before crowdfunding model, and then there's the debt capital markets, which probably not appropriate for anyone in this room right now. The after debt crisis model is that the friends, fools, and family round has significantly reduced to things that you actually have in your pocket. So what I like to say is that this bit is your test as an entrepreneur. If you can't bootstrap, then I don't think you've got the qualities to be an entrepreneur. That's what I really believe, that this very, very early stage is where you really get creative. You've got to figure out how to build a prototype, how to attract a team around you. And once you've got that, you then got something that can be pitched into a different form. So what happened originally? So banks, they're not interested in small business. I believe they're going to exit the business market altogether in the future. The reason being is if you're a bank and you've got money, you'd much rather lend to deposits. You'd much rather lend to property secured by property, or people that have got jobs secured by credit cards, secured by their job, or you'd much rather get involved in shadow banking and all the speculative stuff that kills our economy. But when it comes to small business, limited liability is a step too far for them, especially with the new regulations at the moment. So it's ripe for disruption. Now, this is where crowdfunding came along. How many people have heard of crowdfunding before? Okay, so almost all of you. So crowdfunding is the process of putting a pitch on a website. We founded BnkToTheFuture.com. There's other people out there as well. And what you do is you offer rewards. Now, I think that this is the best financing method at the moment for early stage ideas. Now, there's some caveats to that. It works better if you have a consumer product. If you're in a B2B market, it's really challenging to get people to back you through crowdfunding. Because what crowdfunding relies on is you creating a lovely video pitch of what you're up to and inspiring a lot of people to share it through Facebook, through Twitter, through LinkedIn, and get you essentially the best model, I think, for crowdfunding is pre-selling your products. Now, the reason that I'm very excited about crowdfunding is the classic story is someone, if you're trying to raise money for your widget, your watch or something like that. You've created some digital watch that takes mobile payments and you want to sell it for 200 quid. You can say, well, it's going to take us 9 months to deliver upon that promise. But if we raise 100 grand, we can actually build that. Here's the prototype. Here's our suppliers. We're going to sell it for 200 quid. But if you give us 100 quid now, then in 9 months you can have the order. So essentially, it's kind of like a loan. But you don't need to repay it, and it's free money essentially. You're forward selling your product. The reason that I think it's best here is because you get to determine a few things. The first thing you get to determine is, do you have a product that people care about? And that's really nice to know up front before you've got VC funding and lots of money and you put your whole life into it. And many people get 5 years down in the business and realize they've got a product that no one wants. Secondly, it tells you if you can't pitch and inspire people to get involved in what you're doing, then maybe you don't have the right people on the team to market and pitch and the salespeople that are going to be required in order to take this product to market and persuade other people to invest in you. So crowdfunding is that first early stage. The record that it's raised so far is $10.3 million, but it's typically less than £10,000 or so is a typical crowdfund. Once you've done crowdfunding, the next stage is that we've got this thing called crowd investing. So crowd investing essentially has taken the process that public companies go through and it's made it accessible to small businesses looking to raise small funds by offering shares to a crowd of investors. The beauty of crowd investing is it consolidates small sums of money with larger sums of money. So you can go out and you can pitch all your angels as normal and say, in 3 months' time, this pitch is about to expire. We're looking to raise 100 grand. If we don't raise it, we have to give all the money back. If we do raise it, then we get our finance, essentially. So the hardest thing with angel investing is 2 things I found. One, no one wants to be the first investor. So if you can get lots of small friends, family, people that can invest as little as £10 to provide your first bit of funding, it gives some social proof that people are actually interested in what you're doing. The other thing is they want to drag the process on and on and on, and you can never get them to put the money in the bank. So with crowd investing, I've actually done the wrong one here. Sorry, I was looking at I'll swap those around. With crowd investing, it gives that deadline, so where people can actually invest. And you go out there, you pitch like crazy, and people can invest online. The bit that's slightly disruptive from the bank side, so that's crowd investing. You can raise larger monies than you can typically raise through crowdfunding. Crowdlending, the industry calls it peer-to-peer lending. At BnkToTheFuture, we call it crowdlending. BnkToTheFuture, essentially, it walks you through this life cycle. So you crowdfund at the beginning, then you raise crowd investment finance as you build a good management team and a good investment case, a good business plan. And then once you've got cash flow and credit rating, you can borrow from the crowd. So essentially, the way crowdlending works is you say the terms that you'd like to borrow at. And if you're creditworthy and your company has been traditionally what a bank would have lent to in the past before they exited, it matches you up with hundreds of people that are looking to lend money at that rate. And you just put the two together and you might get a loan at about 8 to 10% depending on the risk that you're actually doing. The platform manages all the repayments and it goes through. So here's what we think has actually changed. We think the friends, family and fools round is a lot smaller now. We think it's a lot easier to bootstrap. We think it's a lot easier to get something started than it ever has before in history, thanks to technology. We think it's a lot easier to test an idea rather than going and begging a bank manager or getting your parents to put 50 grand that they can't afford. Crowdfund it, test the market if you've got the right type of thing. If you want to raise further finance as you build a good management team, you can consolidate angel money with new forms of money through a crowd investment. And then as you grow, as you get a good credit rating, you can borrow from the crowd rather than actually borrowing from the bank. We think that this bit will remain exactly as is. Really the goal is to get yourself in a position where you're ready for a venture capitalist if you need further finance, where they can access further resources. But we do think that this market's actually going to grow and do something a bit disruptive in the venture capital market as well, which is why very many venture capitalists are very vocal about how rubbish crowdfunding is at the moment. And there's this real interesting debate between us. So we were quoted in The Independent and all the traditional financiers are saying, yes, but what about regulation and all this stuff? So there's a real interesting debate at the moment between traditional forms of finance and disruptive forms of finance and where it's actually going. And I'd love to engage in that debate with you. And you know, we've got some interesting times ahead. And this is all working perfectly well. But the interesting thing to me is, what if Manchester United, rather than going public, had someone in their an FD in their team that realized with a load of raving fans like Manchester United, they could have raised the exact same amount of finance through a crowdfunding platform. Why? Because they've got the investors, they've got the database, they've got the rabid fans already, and they wouldn't have had to give away any of the equity. I'll leave that thought with you. Is it going to disrupt something around the equity capital markets? Let's watch this space.